Other former turtles, such as Curtis Faith, have portrayed an image of success, but in terms of trading to make millions, this group of 6, this was it. So what happened to them? So this is the questions I want to ask, and we're going to try and answer that and see if we can come up with an answer that would help us in our trading. Okay, so the first question, what separated them? Why such discrepancies? Why, when they all had the same trading rules, did some turtles not make it in the long run? So what beyond pure intelligence enabled turtle Jerry Parker's, which is the top guy there, 20 years of great performance? Now, many of the turtles were very smart. However, a high IQ is hardly the key to success in life. Intelligence ensures absolutely nothing in the long run. Success requires something more than that, more than the intelligence. So what beyond pure intelligence enabled this turtle Jerry Parker's 20 years of great performance? What was the line between those turtles who achieved huge trading success after working for Dennis and those who failed at trading? The contrast between the last 20 years of actions between Jerry Parker, the most successful of all traders and now arguably a billionaire, and Curtis Faith, who never traded successful after 1988, may be a great lesson to be taken away from this turtle experiment. And this is what we're going to try and do here, to see what we can take away from this experiment. Now, Dennis turned on the lights and he supplied the brokers, the money, and the system to the turtles. But with Dennis out of the picture all of a sudden, the turtles had to answer for themselves as to whether or not they had the ability and the desire to succeed on their own. Now, what distinguished Parker? Now, here's one of the answers, the possible answers, and this might be applicable to precisely you that's sitting there. Okay? Now, what distinguished Parker from most of the other turtles was that Parker always had the self-confidence to believe that one day, listen to this, he believed that one day his earnings could rival those of Dennis. Now, the other turtles, most probably those that didn't make it of the 13, when seeing firsthand that Dennis earned $80 million in 1986, they may have thought, well, that could never be me. I could never make that kind of money. Oh, sorry, no, that is Dennis, that's not me. I mean, can you see the self-doubt? Can you see that the self-confidence between Parker and the other traders there? A few of the other traders, they even confessed that they just felt lucky to be a turtle. You know, there was much more to long-term success than just being a turtle armed with trading rules. Now, the contrast between the last 20 years of actions between Jerry Parker, the most successful of all the turtles, and now arguably a billionaire, like I said, and Curtis Faith, who never traded successful after 1988, may be a great lesson to be taken away from the turtle experience. This is the last question that we asked there. Now, let's look at possible answers there. And I believe this is it. So, self-confidence. It showed there that Parker had the self-confidence. He believed that he could earn more than Dennis, and he would one day earn more than Dennis. And he became a billionaire. The others had self-doubt. The others thought, no ways. I know, I saw with my own eyes that Dennis has earned $80 million in one year. How on earth can I do that? You see, and this is where your thoughts come in. This is where that why that I was talking about in the first webinar, and that business plan of yours comes in. I mean, if you've got these doubts about yourself, why on earth are you doing this? If you're doing Forex just for a sideline, I mean, guess what? You're going to get a sideline income. If you're doing Forex to just pay for your children's tuition, that is the income you will get from it. But if you really set your mind to it and believe in yourself, then you can do it. So, self-confidence is the first one there. The second one, self-belief. Close by the same. They did not believe in themselves. Listen to that other turtles that says, well, they feel that they're just very lucky to be a turtle. I mean, what mentality is that? I mean, it's amazing. I mean, they've been trade and they made $175 million in 5 years. And you say, I'm just lucky to be a turtle. I mean, it is absolutely amazing. An attitude of I can. Maybe that was short there. Parker had that attitude, I can. I know I can. It's not Dennis, it's me. I know I'm using Dennis' money, but it's me. It's me that is doing the trading here. So it's an attitude of I can. And then, like I always say, if it's to be, it's up to me. I don't blame anybody. I don't blame the system. I don't blame the market. I don't blame the news. I don't blame whatever. I don't blame China. I don't blame Japan. I blame myself. If I made a mistake, I blame myself. That's it. Because I say if it's to be, it's up to me, nobody else. And then this saying that I said, you can either say, I will be part of the 5% and not the 95%. And if I say this, guess what? I'm right. You can go into debate with me, but I can tell you I am right. But if I say I cannot be part of the 5%, I'll stay part of the 95%, then also you're right. It's the way you're thinking. It is the thinking pattern that you put onto yourself. So just take that off immediately and believe. Have self-confidence, have self-belief, an attitude of I can, and say if it's to be, it's up to me, and I will be part of the 5% and not the 95%. But let's look at other very important lessons that we can learn from this experiment. And we can maybe apply this in our trading. And now this is where a lot of nuggets, I'm sure that you've picked up a lot of gold nuggets in this first half of this experiment. But now this is the part where I've really studied it and I've pulled out the good pieces that we can use. So let's take a look at this. Number one, a complete trading system. Now, let me just pause here for a while. In studying this true story of the turtles, and I really went in and I got some books and I got all information that I could get. So this is what they had. This is what I found, that this is what the turtles had. So I was trying to see what was it that the turtles had, what were they doing, how were they doing it, and this is what I found out. Number one, they had a complete trading system, a mechanical trading system. Now, the components of a complete system includes markets, position sizing, entry, stops, exit, tactics. Now, what does this mean? A mechanical system, trading system, for those of you that's very, very in the beginning, that means it's a system that tells you precisely what to do. So the system tells you if this happens, and this happens, and this happens, then you do this, and this is how you do it, and this is when you stop doing it. So you get my point. So it's a system that tells you precisely. You don't have to do any thinking. So this system tells you precisely, do this when this happens. Do this when that happens. If this doesn't happen, don't do this. So, and there's a set of rules that make sure that you see this. So number one, it tells you which markets to trade. That means which currencies. So if it tells you, listen, you trade this currency pairs, this is the ones that you need to trade now. Then number two, it tells you what is your position size. I mean, how many volume, how big must the volume be to put onto that specific trade. It tells you precisely where to enter it and how to enter it. It tells you precisely where to put your stop and how to put it in. It tells you precisely where your exits are or where you should you put your take profit. And then it's got a set of tactics for you of what you should look out for and what you should not look out for. Now, this is the first thing that the turtles had. They had a complete trading system. A complete trading system is a mechanical trading system. Now, most successful traders use a mechanical trading system. Now this is no coincidence. Absolutely not. Because a mechanical system, a good mechanical trading system, automates the entire process of trading. The system provides answer to each of the decisions a trader must make while trading. The system makes it easier for a trader to trade consistently because there's a set of rules which specifically define exactly what should be done. The mechanics of trading are not left up to the judgments or emotions of the trader. And this is very important. Did you hear what I say there? The mechanics of trading are not left up to the judgments or emotions of the trader, especially the beginners. Because in the beginning you've got that emotions, and it's absolutely normal. I've been through that emotions. I can tell you about emotions. I can write a book on emotions in Forex. So this system gets the emotions out. Can you see why Dennis decided he'll be able to teach them in a question of 2 weeks' time, and then test them for a month, and then, give them the responsibility of $500,000 to $2 million of your own money. That takes courage. That takes courage, and that takes knowledge that you know. So it is absolutely essential that he knows what he's doing. And he knew what he was doing because he knew his system and he knew his rules. And he knew that this was a mechanical system, and he knew that all that he had to do is teach them the rules and how to interpret the rules, and they sit there in an office and they've done it. That's it. So if you know that your system makes money over the long run, it's easier to take the signals and trade according to the system during periods of losses also, because you will find periods of losses. And when these periods of losses come, you will know, stick to the rules, stick to the rules. Just stick to the rules and the winnings will come. So if you are relying on your own judgment during trading, you may find that you are fearful just when you should be bold, and then you'll be courageous when you should be cautious. Now, if you have a mechanical trading system that works and you follow it consistently, your trading will be consistent despite of the inner emotion struggles that might come from a long series of losses or a large profit for that matter. The confidence, consistency, and discipline. I'm gonna repeat that 3 words again. The confidence, consistency, and discipline afforded by a thoroughly tested mechanical system are the key to many of the most profitable traders. So I'm going to say that last sentence again. It's so important. The confidence, consistency, and discipline afforded by a thoroughly tested mechanical system are the key to many of the most profitable traders' success. The Turtle trading system was a complete trading system. Its rules covered every aspect of trading and left no decisions to subjective whims of traders. It had every component of a complete trading system. Now, let's look at the components of a complete trading system again. We just did that. We said the complete trading system covers each of the decisions required for success trading, like markets, when to put the trade in, where do you put your stop loss, which currency to trade, when to exit, and other tactics around that. So, to summarize, if you have a profitable, I said that to you, if you have a profitable mechanical trading system, you cannot go wrong. And if you follow it religiously, then your trading will be profitable. And the system will help you survive the emotional struggles that inevitably results from a long series of losses or large profits maybe, like I said. The trading system that was used by the Turtles was a complete trading system, mechanical trading system. Now this was a major factor in their success. Their system made it easier to trade consistently and successfully because it did not leave important decisions to the discretion of the trader. That last part, I must repeat that, because it did not leave important decisions to the discretion of the trader. So absolutely, you must trust your system. Now, but you cannot only do it on that. Number 2, consistency. This is very important. And it just came out there in that piece that we had now. The turtles were told to be very consistent in taking entry signals. Because, listen to the reason. Because most of the profits in a given year might come from only 2 or 3 large winning trades. Now remember, they trade on either a monthly charts or longer charts because they traded huge money. But I mean, you can apply this on your chart that you're trading, whatever it is, maybe 1 hour, maybe 4 hours, maybe daily. Now, because most of the profits in a given year might come from only 2 or 3 large winning trades in a month or in a week or in a year, whatever, if a signal was skipped or missed, this could greatly affect the returns for the year. That's why consistency is so important. Now, the turtles were given the discretion of not trading any of the currencies that they have there on the list. But listen to this, it's also important. If a trader chooses not to trade that particular currency, then he was not to trade that currency at all. So, in short, what am I saying here? You're not allowed to jump around. I mean, don't sit here and you trade, for instance, with let's say this, the majors. Okay, that the majors for the beginners is all the currency pairs that's got the US dollar in it. Okay, so it could be the US dollar CAD, Canadian dollar, the US dollar Swiss franc, the pound US dollar, the Australian US dollar. You get what I'm saying. So, if you decided the others, we call them the exotic pairs, or others. But the point what I want to make is this: if you decided not to trade the others, if you decided just to trade that 7 majors, what happens? If you don't find a signal on all 7 of the pairs that you're trading, don't go and look now for all sort of strange pairs to see if you can't find a signal there. This was one of the traders' rules there. They said a trader could choose not to trade a particular currency, but then he was not to trade that currency at all. If he decided, when he started off there, he decided, I don't want to trade that currency, I don't like that currency pair, I don't like that currency pair. That's fine. Take them off the table. But you will not trade them now from here on, even if you don't have a signal for a week on the pairs that you are currently trading. So you are not supposed to trade other currency pairs inconsistently. Now, the turtles with the best trading records consistently applied the entry rules. Listen to this. The turtles with the best trading records consistently applied the entry rules. The turtles with the worst records and all those who were dropped from the program failed to consistently enter positions when the rules indicated. It is so simple. It is so simple. And we know it's so simple, and we know that this is, it is a no-brainer. But why do we still do it? Why do we still break this rule? So, for the sake of the beginners out here, and you guys, again, I'm going to read this one, the last one. The turtles with the worst records. Now, this is the statistics that Dennis took there. So, the turtles with the worst records and all those who were dropped from the program failed to consistently enter positions when the rules indicated. That was it. That's what they found out when they look at afterwards at why was it, why did they fail. The third one, stop placement. A very short, sweet, but absolutely important one. The turtles placed their stops based on position risk. No trade could incur more than 2% risk. Did you listen to that? So, no trade. They will never go into a trade before they plan this whole trade. Then they see there will their stop loss be. They found out how many pips is it from there. Then they know precisely what the risk will be. Then they work the volume according to that. the volume was worked out according to the amount they want to risk. They would never ever risk more than 2% of their total account on a trade. That's it. Simple. And I said this to you in the previous webinar. Never ever risk more than 2% of your account on a trade. In the previous webinar, I said something else also. Never ever have more than 3 trades in at a time. If you have to have more than one trade in, make sure that the total risk is not more than 5% of your total account.